My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour is Carson Block. Carson, for those who are not familiar with you, introduce yourself. Who are you? What's your background? You get involved in markets, and what are you doing currently?
Sure. So I founded Muddy Waters Research, Muddy Waters Capital. So we manage we've got strategies that to date have primarily revolved around activist short selling. So basically for the past 13 years, I've been so-called activist short seller. Before that, I was in China where I was a lawyer, and then I opened the first self-storage company in mainland China, which was a very embittering, disappointing experience. And before that, I grew up in the capital markets. My father was an equity analyst, and so kind of taught me the trade from a young age. And I learned enough to end up basically thinking that a lot of this is bullshit. And so, my business is looking for this bullshit and trying to profit from exposing it.
The term activist short selling, I think you hear that in the media, but I don't know if how many people really understand what that means. Most people, when they think short selling, they're just thinking, look at a chart and it's going down. Explain what activist short selling is.
Sure. So first I'll start with traditional short selling. So traditional short selling is a niche in the investment world, but the cornerstone of traditional short selling is basically identifying melting ice cube businesses that for some reason you think you understand that the ice cube's melting faster than the longs do, and you short it. Now, it's been a number of years since that was thought of as a way of making absolute returns. It's generally basically a way to make alpha. So historically for short only fund managers, their clients are these large allocators who are long the world, and they're saying, hey, generate alpha for me. And so in years when the markets don't perform well, I'll get a little bit of insurance payout basically from investing with you. Now that's traditional short selling. It's debatable as to whether shorting scams, promotions, frauds is really a good idea for traditional short sellers. They've always been attracted to it when they discover that something is a fraud. But the problem is, if nobody tells the world that this thing is a scam or a fraud and proves in which ways it is, I don't know, it can rip on you far more than I would argue a melting ice cube that you get wrong rips on you. So activist short selling, it existed before I came along 13 years ago, but it was very, very niche. It's basically Andrew Left of Citron Research, this guy Manuel Asensio, occasionally Dan Loeb as Mr. Pink on the Yahoo message boards. And they were focusing on microcaps. So really egregious, scammy companies where they would just publish information seeking to refute whatever management was saying. So they would take short positions and then they would go public and say, no, this is all a lie. The technology is not really there. When I came along, I was living in China. This is 2010. And I had this, struggling self-storage business where it felt like every day that I got up every day and felt like I'd soon thereafter get, kicked in the balls, basically. But there was in 2010, my father had gotten really excited about these Chinese companies that had listed in the US via reverse merger. And I had no inclination at all that there was systemic fraud. But he asked me to diligence one of them. Is this company called Orient Paper. So I was reluctant. I really felt like I had my own problems and I just, that was taking enough of my time, but it was my father. So just started looking into it. And it was clear that there were just numerous lies about the business and everything. And we ended up going on site and seeing this Potemkin factory. So I didn't really know what to do with this. But in June of 2010, I bought $2,000 worth of put options because I was effectively broke at this point in time since I'd incinerated my life savings in the self-storage business and was in debt. So, basically hit up my credit card, $2,000, buy some put options, had no idea what I was doing with the put options in terms of trading, and sent this report, like a 30 some odd page report, just evidencing how this company called Orient Paper was a total fraud. It had reported $103 million in revenue the prior year. Real revenue, was $2.5 to $3 million. And anyway, sent it to 50 people I'd last spoken to in the markets. 9 years earlier because I'd been out of the markets for that long. And the report went viral. And, next thing I know, the stock's down 55% the day after. And I'm getting death threats, and Jim Cramer's on CNBC screaming about, this guy and self-storage guy in China who's a fraud and taking all these arrows. But I then learned that this was systemic with these Chinese companies. And we won the war with Orient Paper. We didn't get a kill shot that would have gotten it delisted, but, it became clear to the vast majority of market participants who cared that the thing was a fraud. And so then basically this business was born where for the first few years, it was these frauds from China that were listed in the US, put together 30 to 120 page reports, just with all the evidence that these things are frauds, take short positions ahead of time, send the reports out. And so in June of 2010, I was a dude sitting in a tiny or subscale self-storage warehouse in Shanghai, China. 1 year later, Bloomberg named me one of the 50 most influential in global finance with Jamie Dimon and Warren Buffett, and it's like winning the lottery, really. So, here I am 13 years later. I'm still more or less doing the same thing, but it's, we do this globally because the way what I came to, realize, and this isn't a great revelation, but, stupid criminals go and knock over liquor stores. Smart criminals go to where the money flows, and that's the capital markets. So wherever there is liquidity and stock borrow, there will be people doing things they shouldn't do. And, there's an opportunity for activist short sellers. And the final thing I'll say on this is, while the origin of my business was dealing with complete frauds, I think the bigger problem that the world has is the stuff that's probably not over the line from a legal perspective. These guys have enough lawyers that they don't violate the letter of the law, but they violate the spirit of the law. And lots of companies can publish highly manipulative financials, say things that are really misleading. And at the end of the day, they have enough plausible deniability that nobody's really going to go to prison. And that by number and aggregate market cap is the far bigger problem that the world has. So that's where we spend most of our time now, is stuff that's highly complex financials and accounting, and just basically sifting through that and saying, look, the economic reality of this business is not $1 a share. 50 cents of that came from transactions with, deconsolidated affiliates that really should be consolidated, funded by debt. It's not $1 a share. It's really 50 cents a share in earnings. So that's what we do as activist short sellers.
We'll expand the conversation, but I am curious that you mentioned puts. As an activist short seller, I'm going to assume that you would rather do outright shorting as opposed to playing with options, because then you have to deal with time.
Well, the short answer is yes, but not for that reason. So again, with that first one with Orient Paper, I didn't know what I was doing. A few years later, I went back and I tallied up all my trading, and I realized that I lost $600 net on my, the day after we published, those options were worth $20,000, $25,000 at one point, which at the time was all the money in the world to me. And I was like, oh my God. And I didn't know enough to understand that it's because the vol was, had spiked and I should sell at that point. But no, the issue soon after, because that Orient Paper report, not only did it begin a business for me, but it created a lot of other activist short sellers who because it was the first time somebody had basically proven to the satisfaction of most of the investing public who cared anyway, that one of these things was a fraud. So a lot of other activist short sellers came out of the woodwork to copy the model. And especially with these Chinese companies, it was like the gift that that kept giving. So problem became that everybody was loading up on put options right before publishing. So after a few months, basically, what happened was traders figured this out. They're like, okay, somebody's hoovering up these puts that are deep out of the money and are 1 week from expiry, in a Chinese company. Somebody clearly knows something. So the vol would blow out. And then what happened is companies got tipped off. So, they had ways of, a lot of these things are, look, why commit a fraud if you're not also going to manipulate the stock? So a lot of these guys had access to manipulation kitchens. And so the concern was that they would get their money ready to just start lifting offers as soon as you put your report out. So it became, the problem with options is it was just tipping off the market as to what was going on. And, if you fast forward to today, we manage outside capital. And so it's pretty rare that there's going to be enough liquidity in the options market on something that we're shorting. It's pretty rare for that to find the liquidity that would move the needle for us P&L wise. So the way we look at it is like, hey, upside downside on this, like why tip off the market that something's, potentially coming? Let's just sit back and focus on the common.
That makes a ton of sense. Okay, so I want to get into the thesis that you teased out by email to me, the New World Order. And again, I used to be an old wrestling fan, so when I hear New World Order, I'm thinking Hulk Hogan and all those guys back then. I know that's not what you mean, obviously, but lay out that thesis for everybody. What is the New World?
Well, I guess the phrase has probably been overused quite a bit, so I should have maybe tried to be a little bit more original. But so I obviously have an extensive background with China. So I've lived there twice, total of about 6 years, practiced law there. I co-authored a book for the For Dummies series, which is actually was written, unfortunately, way above the dummies level, but it's doing business in China for dummies. And so, I fancy myself a China expert, although most people who say that you should ignore. So take this with a grain of salt. But so there we were in April of 2020, and COVID had just started sweeping the world, or had just swept the world. And I read this column in the Washington Post in which the columnist broke the news about these State Department cables that had been sent in previous years about the Wuhan Institute of Virology and its its level 4 lab not being up to snuff in terms of safety. And I really cogitated for a little while on that. And I came to the conclusion that there are two possibilities here, right? Either it came from the lab or it didn't come from the lab, then, it came from the wet market. But either way, the lab thing is obviously a major problem. I mean, they were warned, by the state, by the US State Department at the time, the National Institute of Health. But even with the wet market thing, I remember the first SARS that supposedly came from civet cats in a wet market. And so I'm looking and I'm saying, the world is basically on fire right now because either way, China's government was at best negligent in, trying to prevent something like this from happening, then basically covered it up and lied to the world about it, which, certainly didn't make it any easier to avoid this. And the way I'd been looking at the West's relationship with China for some years was that I felt that China had really lost a lot of popular support, among the people. But the thing is, our at times treasonous multinationals were always happy to sell out, national security and future generations for the sake of making this quarter's numbers. And, they were able to basically buy off enough politicians to keep everything business as usual. And, Trump started to change that. But, when I thought about what COVID was doing, I was like, you know what? I think the popular anger, I think, we will all emerge from this so fucking furious about what has happened to our lives that I don't think the politicians and the, kind of corrupt multinationals will be able to hold the dam anymore. And the dam will break, and it's going to be a complete realignment, or it's going to be a significant realignment of geopolitical relationships, namely how the world relates to China. And so I thought, okay, that's, that's cool. What's the trade? So the first thing we looked at was, well, what do you short? And that was really a hard one. It wasn't like the global financial crisis, if you saw that coming, where it was obvious because, you're talking about global dominoes, like what's going to fall and when. And we really couldn't figure it out from that perspective. So almost begrudgingly, I asked, well, what do you go long? And in so many ways, the long side business is much better than a short side business. But those answers were, it's clear who the beneficiaries are going to be. But to us, and I think this one's also kind of obvious, but sort of talking my book here, but I think the largest beneficiary from this realignment and basically the redirection of FDI flows that would have gone to China, biggest beneficiary relative to the size of its economy and its capital markets, I think, will be Vietnam. And so we said, okay, let's open an office in Vietnam. And we opened that office in Vietnam almost 2 years ago to get ready to launch a Vietnam strategy. Well, I mean, really the New World Order strategy. But, one of the hallmarks of this also is that countries that are not aligned, or countries that sit in the middle, basically between the two poles here, are going to be, I think, in general, best positioned in the world. So you kind of see, Saudi drifting, towards the center, away from the U.S., see India getting closer to the U.S. But I mean, all of these dominoes, to use that analogy again, all these dominoes are falling right now, and these realignments are occurring. And, I would argue that I can draw a clear line from this to, the land war, which is a big land war that's taking place in continental Europe right now. So yeah, that's the New World Order kind of origin and thesis, and how we're looking to capitalize on it.
All right. So I think this is actually really interesting because I've looked at Vietnam, at least the ETF, in the past a few times. But talk about the sort of market depth in Vietnam. So you've got the office there, you're going to create, or you have the strategy around trading Vietnam stocks, investing long short. What's the depth of the market? How many stocks are there? Because it's obviously a lot smaller.
Yeah, no, I mean, so first of all, I mean, we don't think that there's edge in being an active trader in Vietnam. It's a frontier market. And, the locals, when it comes to the day-to-day movements, I mean, yeah, that things aren't on the up and up, relative to the US. So you're going to lose that game to the locals. So we think that the way to benefit there is a buy and hold strategy. Now, when you look at the ETF, that mirrors the index. And the problem is with the index is that it's generally, I mean, the most significant portions of the index are real estate developers and banks. And real estate developers, look, not shockingly, and when you look at even the West, how we've gotten overextended in real estate. In Vietnam, there was some real excess, and some of the developers are in real trouble. And that's washing up somewhat on the banks. Some banks are reasonably well positioned, others have real exposure, but that's also creating a bit of a credit crunch. So that's the problem with playing the index there, is that you're going to have outsized exposure to them. Now, the kind of flip side funny thing is you also get a lot of exposure to the Vin Group, which is the largest conglomerate in Vietnam, largest privately owned business. And they recently IPO'd or SPAC'd a subsidiary called VinFast. And now VinFast has ripped. The reality is it's a tiny float, right? So it's probably more for technical reasons than for fundamental reasons. But that's also helped create enthusiasm, for the Vin Group stocks as well. So that's kind of pushed up the index, and it'd be reflected in the index fund. But how to play it, we generally like the Vietnam mid cap space, which a mid cap in Vietnam is, much smaller than mid cap here, but like 500 million market cap, maybe up to $1 billion market cap for the most part. There are companies where at least we think management is focused on the long term. The accounting can actually be kind of conservative in ways, surprisingly, but I think you have to, it's a part of the world with, where you don't have the strong rule of law that you have in the West. And so you really need to look very carefully at what you're buying. And when we were on month 2 or 3 of having our office there, a lot of the things we thought were probably going to be core holdings by month, 13, we're like, no, we understand why we would not want this in the book. So it's a hard market. It's a hard market to play in. And like I said, I mean, you could do the index, but you really have a lot of concentration there in the index. So it's not giving you a good diversified exposure to the Vietnamese economy.
What's the sort of sector industry makeup of the equities there? Is there an overwhelming industry that dominates the stock?
Well, again, by size, you're looking at real estate developers and banks. But if you think about, okay, if we don't weight market caps here, you get a lot of, like very basic industries there, like paper manufacturers, water treatment companies, like, utility, power operators. So it's these companies are generally pretty simple. Distribution companies, there aren't really, there's not a ton in the way of homegrown tech companies there because, when it comes to, say, software or social media, you just don't have the scale in Vietnam that you have in China. Like, well, Vietnam will never in and of itself replace China. But yeah, like one of the companies that's actually one of the better run companies, it's tough to buy it as a foreigner because they're these caps on foreign ownership for Vietnamese stocks. And this company FPT, they do a lot of offshore software development, and they've done very well. But that's one where like everybody wants to buy it. It does appear to be a well-run company, but that's kind of an outlier there. You're mostly looking at industrial. If you want to get away from like hugging the index, you'd be mostly looking at heavy industry or basic industrial type companies and some consumer companies.
Has there been anything interesting on the political front and government front in terms of more interaction between the U.S. and Vietnam on controlling reshoring?
Well, Biden was just there last week, so that was huge, and it's the first time a U.S. president has visited Vietnam since the war. And yeah, I mean, the U.S. definitely wants to build up Vietnam as a strategic partner, but Vietnam gets that it needs to, really just needs to balance the U.S. against China. And I heard when I was in Vietnam last summer, I spoke with somebody who is an official at the U.S. consulate in Ho Chi Minh, and they said something really interesting. They said, in talking with Vietnamese government officials about the war in Ukraine, they're of the view that it was Ukraine's fault. And I said, really? I said, well, here's the way they look at it. They say, look, as Ukraine, you are not a power. You are sandwiched between, this huge power of Russia and the West. And you should not do anything to antagonize, either power to the point that it can become hostile. You have to balance them. So that's how Vietnam looks at its role or where it's positioning between China and the US. And now the Vietnamese public writ large hates the mainland Chinese. They fought a war in, I think it was 1973. They really just despise China. Now, not so much with Taiwan, because I guess they've adopted that, attitude of the enemy of my enemy is my friend. But with mainland China, and that's really why the foreign ownership limits exist, is because when it comes to these stocks, is because Vietnam, and I think this is right. They just want to make sure that they are not subsumed by by China and Chinese entrepreneurs and Chinese investors. But yeah, look, Vietnam is never going to be, a U.S. ally in the sense that they're not going to align themselves with us against China, because that would obviously be highly provocative to China. But Vietnam will be happy to be an irritant to China, vis-a-vis increasing the depth of its relation or deepening the relationship with the U.S., but not to the point where they could be accused of being U.S. aligned.
I am curious, actually, on the situation, the real estate side. Has there been a lot of appreciation there? I've had some people from Australia on these spaces, and they've noted that property prices in Australia have gone vertical because a lot of money from China has gone into Australia. I don't think they have caps in the same way you're alluding to when it comes to Vietnam. How's the property sector there?
Well, yeah, I mean, look, in the era of, cheap money, I mean, the rates were, for FM status were low in Vietnam. There's tremendous amount of speculation on real estate, particularly apartments. I mean, it's, that's just kind of like an Asia, pan-Asia phenomenon, especially after the GFC. So yeah, the price of, especially at the high end, luxury real estate really ramped up, and beyond where it's what I guess you could say is its fair value. But look, I used to sit in mainland China in 2005 and say, this is insane. There's no way this apartment should be 20,000 RMB a square meter, sale price. And then a couple of years later, it's 25, then 30, and then probably by the time everything imploded, it had hit 50 or 60,000 a square meter. So took a long time for those chickens to come home to roost. However, State Bank of Vietnam had to raise rates in order to protect the currency when the US and ECB hiked. So they've recently cut rates somewhat because they're just trying to balance that, growth versus, or issues with the currency and inflation. So they're trying to walk a fine line, but real estate has come under significant pressure since the rate hikes.
Just to reset the room for everybody here, please make sure you follow Carson Block here on X. If maybe you want to come up and ask questions, click that bottom left mic request button. And as always, again, this will be in podcast under Lead Lag Live on Apple, YouTube, and Spotify. But let's do a little bit of a hard pivot from Vietnam to ESG, which I know you've been, publicly outspoken against that. You mentioned that you've shorted some stocks in the space. ESG was all the rage up until last year, and then energy took the national conversation, and ESG seemingly now is a lot less pushed than it was for now. Lay out just some of your thesis around why ESG is bullshit.
Okay, yeah. So, look, let me start by saying I believe climate change is real, and it is caused by human activity, emissions of carbon dioxide from burning hydrocarbons, all of that, is real, and I'm not disputing that. But the issues with ESG, let me back up a minute here or go to an even higher level, which is hopefully not too theoretical or philosophical. But for a number of years since I started this business of activist short selling, I've termed the way that our world works, at least the Western world, I've called it the tick the box apocalypse, right? Like you can basically do anything if you can create enough paperwork and, just tick various boxes. We've been living in society, Western societies, have been placing form over substance in important ways for decades. I really think about our, especially in the US, how the people who generally are the policymakers and hold the levers of power are generally lawyers. So we live in a lawyer's, wet dream, so to speak, because everything is paperwork, right? So with this form over substance reality or, increasing underpinning of our society, now there was clamoring let's ensure that, financial flows are directed away from businesses that are actually doing harmful things and are going to reward businesses that are going to try to solve these problems. But the issue is when we're so conditioned now to just ticking the box, right? So you could say, I bought the solar ETF. I'm cool, right? And everybody along the line is doing this without stopping and asking questions like, well, okay, solar panels, where are they made? They're generally made in China. Okay. How are those factories powered? They're powered by generally coal-fired power plants. Okay. How did they get here? Well, they get here on cargo ships, right? And those are powered by diesel engines. How much carbon dioxide is emitted, in that process? And, how how long do these things actually last? And what are the alternatives? And, everybody, in the ESG world, the green world, believe for a long time that nuclear is a technology of the past and we need to get away from it. And so we've been, really telling ourselves, we've been hugging solar panels and windmills and ignoring the possible externalities that they create, such as, these windmill farms. Well, they're harming migratory birds, and it looks like offshore wind farms could be harming whales. And it's not that we should shoot ourselves for doing that at this point, but it's symptomatic of the fact that we've rushed headlong into adopting these technologies without really asking questions. And so when you take that to the capital markets level, ESG, so I guess a pure form of ESG would actually be, despite my criticisms of it, solar ETFs. But, when you look at the big, what it's become, what so much of ESG has become in practice is it's just checklists, right? So about a year ago, that's when Ron DeSantis, was part of the anti-woke thing, throwing meat to the, his base, red meat to the base. He, I think, signed as an executive order or there was legislation prohibiting Florida's public pension money from being invested in so-called ESG funds. And then there was a Bloomberg op-ed written by one of their editors emeritus arguing that this is horrible policy and citing returns on various ESG indices that have, according to the op-ed, outpaced the market. Well, when I looked at those indices, I'm like, whoa, hold on a second here. This ESG index you talk about, it's got the exact same top 10 holdings in it that the S&P 500 does, in basically the exact same weightings. I mean, we're talking, maybe Microsoft was like 7.2% in the S&P and 7.18% in the ESG index. I mean, it was really just minor differences. And yet, when you look at the funds that were the index funds that are pegged to that ESG index, their fees are 67% higher than for their S&P 500 index funds. And so, this is just a joke. People are, a lot of investors, I think, are kind of patting themselves on the back saying, oh, I put my 401k money in the ESG index. And it's like, dude, it's the S&P 500 index, just at a much higher fee structure. And I mean, look, there's a lot to say about the hypocrisy of the ESG movement, but one of my favorite moments over the past few years and kind of my journey into becoming just massively disillusioned with this space was when I met this guy. His name's Tariq Fancy. And so Tariq had been hired by BlackRock to be their first CIO of sustainability. And so he went into that job really pumped, and Tariq's a substantive guy. I mean, he runs a nonprofit. His background had been in venture, but he felt there was a higher calling in life, and so he'd been pursuing that when BlackRock hired him, and he was really excited. He thought, okay, great, here's a chance to make a real impact on the world. So then next thing he knows, he's flying around on a private jet with other BlackRock execs, going from gala to gala, where caviar and champagne are being served and everybody's talking about how wonderful they are for saving the world. And, and he's like, yeah, and at the end of the day, I realized that we're just selling basically the same products at higher fees and we're not doing anything. And so he's written a little, I don't know if I'd call it manifesto about his experience, and he's spoken publicly a number of times, but his words are that ESG is like giving wheatgrass to a cancer patient, that it's doing more harm than good because by ESG being so prevalent, it's causing us or maybe enabling us to say, hey, the solutions are being worked on. We don't have to do the hard work. I don't have to really think about this. Everything is fine and under control when in fact it's not. And, this is an argument similar to an argument that I've made about audits with respect to public companies and fraud risk is that, I can make, I think you could say, I mean, I'm obviously maybe 50-50 or 60-40 on this, but investors are less protected from public stock frauds because of audits, because audits give a false sense of security with respect to fraud. Now they perform other functions, but that's similar to what Tariq is saying here. So the final point that I'll make on this, diatribe, and lots of other points I could make, but maybe there are questions that can lead me there or we move on. The final thing that I'll say is that problem, I think really one of the problems is that, you've got government subsidies here that drive a lot of this. Now, I haven't voted for Republican for president and, I don't think I ever have because I started voting in 94. But, so I don't want people to think that I come at this from a hard right perspective or anything, but what I've learned, through observation is that once subsidies are out there, it does create these distortions in the market. And what we see, when we look at, say, the public solar companies, and the one that we've done the research on and written about extensively is Sunrun. But, I think a lot of their abuses are common throughout, are common among the big winners. Is that the companies that win in the subsidy-driven economies are not the companies that are providing the best services or the best products or doing things the best, except for gaming the system the best. And I don't really have an answer to that because I do recognize that there are, in certain situations, we have to have a role for government to make certain behaviors or changes more economic. But the issue is the guys with the best lawyers and the most gumption are just going to game the system and make themselves incredibly wealthy in the process. And I think make things, leave things worse off than they would be otherwise, or put out of business the companies that are like, hey, I'm not gonna lie about the basis of this PV system here and rip off the taxpayer. I'm gonna be honest about this. Well, you're out of business because Sunrun just ate your lunch. So anyway, let me pause there and see where you guys want to go.
And actually, the point about these ESG funds basically being S&P funds in disguise. I mean, that's typical Wall Street, right? I mean, create a
Yep.
product that is trying to chase performance, and because the performance has largely been in pain, right, and things like that, then let's find a way to try the ESG. That's not unusual. But if you're going to bet against the ESG, you also don't want to necessarily bet against those. So I guess the question really becomes, how do you even properly identify a company that's more on the scam side and benefiting from the ESG flow as opposed to the large cap characterization?
Yeah, look, I mean, as I said, we've been out there on Sunrun, and so I guess when we became thematic in the ESG space, only in retrospect. So I think the first green tech thing we shorted was September of 21. It was a bioplastics company called Danimer. David, Nancy, Margaret, Robert is the ticker. That's in the dirt where it should be. Then we ended up in June or July of last year shorting a company called Hannon Armstrong that finances a lot of renewable projects. And those guys, I mean, just like horrific accounting, massively misleading accounting. Pays dividends, but that's return of capital, not return on capital. Probably the dumbest guys in the room when it comes to the renewable space. But anyway, so that has gone down a decent bit since we exposed the economic reality that was underlying the accounting. But a few weeks later, we shorted Sunrun. And with Sunrun, we had the great fortune of hitting peak risk, basically having fully built our short position, on this one particular day. The market closed, and about 20 minutes after the market closed, it was announced that Joe Manchin had agreed to a climate bill. So that thing, all the solars opened up the next day, up 25%. And we hadn't yet put out our report, but this was a new fact pattern for me. So we had this discussion, should we put the report out today? And, the secondary point that we were making in the report was that Sunrun was abusing, possibly, actually crossing the line in terms of tax fraud, but it was abusing the tax subsidies. So we thought, okay, well, look, there's a focus today on, fiscal policy with respect to solar and other renewables. Maybe we should let's put the report out today. It could maybe be, part of the conversation. Well, with 2020 hindsight, that was a horrible idea because nobody noticed the report. It was absolutely subsumed by the euphoria and the news flow on the what would ironically be named the Inflation Reduction Act. But the thing is, if you look at Sunrun right now relative to where it was even the day before the announcement of the IRA, it's down a decent bit. So I mean these solar companies have horrible business models. Like they produce negative EBITDA consistently. Like that's a horrific business model, and they just have to keep sucking up money from the capital markets. Now, we're not presently short Sunrun. I mean, we got our ass kicked really hard with that one. But, should it be a zero? Yeah, it should be a zero. Now, does that mean that Carson Block is saying this thing's going to zero? No, because, there are a number of companies out there that really should be zeros, but somehow trade at, 700 million, north of $1 billion market caps. So, but this is, these are non-economic businesses. So I think that a lot of the renewable energy, so-called renewable energy companies, I think a lot of these are really non-economic businesses. You just, it just becomes hard to predict exactly when the bottom falls out for them because there's still this large desire to shovel money into them because people feel good about themselves when they do that. So those are the things that are in tension.
You mentioned that example of sun running and getting your ass kicked on it. I think that's a good transition to sort of a tricky topic, which is how do you manage risk when you're, a believer in something that's going to go down or something that's a fraud? Because to your point, right? I mean, you can be right, but as I always myself emphasize, path matters more than prediction, and you have to manage that path.
Right. So as activist short sellers, I mean, there are elements to this that are not relevant to, your average short seller. And I firmly believe that your average retail investor should not be shorting stocks, but at least single name stocks. But, so the twist here is when an activist short seller goes public, like they want to tell the world or, screaming from the mountaintops, these are the issues with company XYZ. The reality is, if company XYZ does not close down a decent bit on day one, it probably gets ignored because, since the GFC and, the emergency monetary policy that lasted for 13 years, that's also created what I can call this lie to me culture, where, when it comes to equities, long side investors who cared about risk got basically left behind. They became anachronisms or even jokes, derided as value investors. Whereas, the guys who like chopped up the blue pill and, snorted it, and like just bought narratives were the ones who were remunerated. So we still have some of that. We still have a lot of that, I think, lie to me culture left as muscle memory, even today post, rate hikes. So the problem you face as an activist short seller is people have to care. You win over the long run by the company having to answer difficult questions and having to admit like, yes, yeah, well, yeah, no, I mean, the way we accounted for that, okay, maybe they have a point. And, the company internally feeling like, hey, we can't be this aggressive in doing this. So we need to chill out because everybody's watching. And maybe directors and officers start to resign. But you need that pressure, that scrutiny that really comes from the longs. And if the longs get out of, all right, I don't have to care about it, fuck it. And so if the longs don't care about it, then the company's not going to have to care about it, right? So as a short activist, if you're going to win over the long term, you need to have a good day one. Now, the percentage of times, if short activist does have a good day one, I mean, it's overwhelmingly significant percentage of time that the stock is going to continue to fall apart over the long term. Because, short activists, I mean, look, maybe I shouldn't generalize and I'm not speaking about like, your average guy on Seeking Alpha screaming at the top of his lungs about a $110 million market cap company here. But like people who've been in the game longer, even those I don't like, I'll say they tend to be directional. We tend to be at least directionally correct almost all the time. So that basically day one is a key. So what do you do like to manage risk? Well, we hedge on the long side. So we hedge factor baskets. And, one of the things that I think is, this might be obvious, but since the financial crisis, it's been awful for your traditional short funds. I mean, almost all of them have gone out of business. The AUM in the traditional short space, is a fraction of what it used to be. And part of the reason for that is, like the PMs would have on, they'd be short 40 companies or 110 companies, whatever it is. And they think, hey, I'm reasonably diversified. I'm short all these different names. But the reality is you're short like the same factors, so you're short momentum stocks or growth. And when those factors move against you, it's actually, even though you think you're diversified across companies and industries, you're not diversified across factors. And so this is like the underpinnings of the smart beta strategy. But what we do on the long side is we try to, we have software that'll take, stock XYZ and say, okay, well, of its beta movements, 30% is explained by momentum, 15% by global telecom, 8% by this. And so then we will go to our prime brokers and say, okay, we want to create a basket of 30 to 50 stocks that kind of mirrors this factor composition. And that's what we hold on the long side. So on the long side, we factor hedge. Now, on a day when it's like massively risk on, we're still going to lose. Those hedges won't have us perfectly, but it does. But basically, we're trying to create alpha vis-a-vis those factor baskets. So that's one way you do it. Now, the other thing is, it's kind of like to me, the naive, like the textbook view of, how do you trade is, well, if you liked shorting it at $10, you'd love shorting it at 15. But the reality is no. Like you have to, of course, feel like you're right, but more so than you have to feel like you're right, you have to feel like the market will eventually care. And so sometimes we can look at it and say, especially if there was no good day one reaction, we could say, look, the market doesn't care or won't care, and there's no point in holding this. But if the stock squeezes to 15 and, but you feel like, look, I think we're going to get traction out of this, over the long term, you have to trim. You trim. And then when the stock starts breaking, maybe it's when it gets to 8 or 9, then you're like, okay, I'm adding back my position. Now, again, that sounds counterintuitive if you're going based on the textbook, but a lot of these movements, especially when stocks squeeze, it's purely technical type of movement. And, more and more trades and price outcomes in the US markets are determined by algo, not humans actually sitting there thinking like, what do I think the stock is worth? Like, that's what our grandparents did. Like, that's unfortunately not what happens now. So a lot of times you have to just kind of try to figure out like, okay, I think the algos are, calculating probabilities that, will not lead them to buy this thing thinking it's going to reverse or rip. And, you're trying to outthink algos, but that's when you add. But yeah, man, you got to be on your toes. If it starts squeezing, reduce, and then figure out what's going on.
Carson, for those who want to track more of your thoughts, more of your work, and obviously you're active on the podcast and media rounds, but where would you point them to?
Well, I don't tweet or X that much anymore. But look, I also have a website called zeros.tv. So that's ZER, the number 0, ES.TV. And that's dedicated to short type content. But about every 2 weeks, we publish a podcast called Zero Fucks Given. And that's usually my partner, Freddie, and our office manager, Krista. That's, we think we're funny. That's us just mostly sitting around and, riffing on the absurdity of the capital markets in the world and ripping on Tiger Global and Credit Suisse and, all those. So, until Credit Suisse failed, we kind of had this recurring segment of like, this week in Credit Suisse misery porn. But we come out with those about every 2 weeks. The first one, or we're going to release one probably in about an hour, actually. So you can watch them on zeros.tv. They also get uploaded audio only to Apple Podcasts and Spotify. But I'm not sure that there's like a lot of wisdom in there. It's more just us taking the piss. But I guess that's probably where I'm most consistently active these days.
It's a good place to wrap this face up. Everybody, please make sure you follow Carson Block here on X. Thank you, buddy. Thank you, Carson. Appreciate it.
Thanks. Cheers.